Shareholders for dividends. On the credit side, 2024 July the 1st, a balance brought forward of 22,500. So on the credit side, 2024 July the 1st, balance brought forward 22,500. This was paid to the shareholders on July the 10th, so on the debit side, 2024 July. On the 10th, bank cash payments journal, $22,500. Now both sides of the ledger accounts are square. Then on August the 20th, an interim dividend was declared of 25 cents per share. We need to calculate the ordinary shares at that stage. And if we go back to information 3, it says on 30 June 2024, there were 50,000 issued shares. So our number of issued shares would be 50,000 shares times 25 cents per share to give you 12,500 Rand. So on the credit side, August the 20th, ordinary share dividends. General journal. $12,500. This was paid to the shareholders on October the 1st. So on the debit side, October the 1st, bank cash payments journal, $12,500. Once again, both sides of the ledger accounts is square. Then on June the 30th, a final dividend of 36 cents was declared. Again, we need to calculate the amount of ordinary shares at that stage. So we had the 50,000 shares, and then we issued an additional 90,000 shares. 50,000 plus 90,000 gives me 140,000 shares. If we times that by 36 cents, we get an amount of 50,400. So on 2025 June the 30th, the credit side, ordinary share dividends, general journal, $50,400. Of this, 5 cents per share was immediately paid to the shareholders. The rest will be fully settled on 20 July 2025. So only 5 cents is paid. So on the debit side, 2025 June the 30th. Bank CBJ. $140,000 ordinary shares times 5 cents per share amounts to 7,000 Rand. So our main end balances on the credit side, we have 50,400. That must be the same as our debit balance to make the ledger account balance. So what would be our balance carry over? 50,400 minus 7,000 gives you a total of 43,400. So balance carried over for the next year is 43,400. So on the credit side, July the 1st, balance brought forward, $43,400. $1.5.2 appropriation accounts. On the debit side, we'll have 2025 June the 30th. That's the end of our financial year. And we close off 3 accounts to the appropriation accounts: income tax, ordinary share dividends, and retained income. So let's start with income tax. General journal. With an amount of 110,250. Ordinary share dividends, general journal, $62,900. Retained income, $153,550 minus 18,900. And that gives me 134,650. On the credit side, profit and loss account, or our net profit, 2025, June 30th. Profit and loss account. General journal. $307,800. So the main total on both debit and credit side needs to be 307,800. And 5.3, calculate the issue per share of the new shares issued. So it would be the change in ordinary share capital divided by the number of new shares issued. So if we go back to the information number 1, our ordinary share capital in 2024 was 270,000 Rand, and our ordinary share capital in 2025 was 792,000 Rand. So the difference between those two amounts, let's calculate that. So it would be 792,000 minus 270,000 divided by the number of new shares issued, and the total number of new shares issued we calculated as 90,000. So it would be 522,000 Rand divided by 90,000 shares. And that would give us an answer of 5 Rand 80 cents per share. (1.4) Preparation of financial statements. At the end of the financial period, the financial position of the company must be published in the form of financial statements that must conform to generally accepted accounting practice (GAAP) and International Financial Reporting Standards (IFRS) to give all stakeholders and the public insights into the company. Besides the statement of comprehensive income or income statement and the statement of financial position or balance sheet, we will also pay attention to the very important statement of cash flows. The format of these statements must be studied thoroughly so that no time is wasted when writing it down. 1.4.1 Statement of comprehensive income or income statement. The general format looks as follows. Statement of comprehensive income for the year ending 28 February 2025. We will have our net turnover, which is our revenue minus our debtors allowances, in this case 900 Rand. Then we subtract our cost of sales of 300 to give us a gross profit of 600 Rand. We add our operating income. Any operating income could be, for example, discount received, rental income, profit from asset disposal, bad debts recovered, provision from bad debts, adjustments, etc. These income we all add to our gross profit, and that will give us our gross operating income of 800 Rand. Then we subtract our operating expenses, These expenses include salaries and wages, auditors' fees, directors' fees, depreciation, provision for bad debts adjustment, increase, sundry expenses, etc. After we've subtracted our operating expenses from our gross operating income, we will then calculate the operating profit. We add any interest income or finance income to our operating profit, and we normally have a note number 1 for this. This gives us our profit before interest expense. We then subtract interest expense, which is note number 2, to give us our profit before tax of 620 Rand. We minus our income tax for the year of 180 in this example, and this will then give us our net profit for the year after tax of 440 Rand, and we'll also have a note number 9 for this calculation. 2. Statement of financial position or balance sheet. Statement of financial position as at 28 February 2025. Assets. Our non-current assets would be our plants, property and equipment, PPE, note number 3. Any financial assets, and a fixed deposit, in this case from ABSA. If we add all these amounts together, we get 1,980 Rand. The property, plant and equipment will be note number 3 in our balance sheet. Then we go to our current assets, which comprises of inventory, note number 4, trade and other debtors, note number 5, cash and cash equivalents, note number 6. All 3 amounts added together gives us our current assets. If we add our current assets to our non-current assets, we get our total assets of 6,000 Rand in this case. Then we have our equity and liabilities section. We start with capital and reserves, or shareholders' equity, which comprises of ordinary share capital, note number 7, and retained earnings, note number 8. Those 2 amounts added together gives us 3,500 Rand for our shareholders' equity. We then also add our non-current liabilities, in this case a mortgage loan from ABSA, and then we also add our current liabilities, which is trade and other creditors, note number 9. We also have our loan that is payable within 12 months, and if we have our bank that's in overdraft, we add the bank overdraft amount as well. Our capital and reserves, non-current liabilities and current liabilities added together gives us our total equity and liabilities of 6,000 Rand. This must equal the same as our total assets of 6,000 Rand, then your balance sheet balances. Notes to the financial statement, note number 1, interest income. This can comprise of interest on investments or fixed deposits, interest on saving accounts, interest on overdue accounts of debtors, or interest on current accounts. Note number 2, interest expense. This could be interest on a mortgage loan, interest on overdue accounts of a creditor, or interest on overdraft. Number 3, fixed asset notes, tangible asset notes, or property, plants and equipment notes. You have 3 fixed assets, namely land and buildings, vehicles and equipment, with a total column. You will always determine the cost price at the beginning of the year, minus its accumulated depreciation to give you the carrying amount at the start of the year. Then you will have movements during the year. That could be any additions at cost price, asset disposals at carrying amount, or depreciation for the year. Note, only vehicles and equipment are depreciated, land and buildings appreciates. Then you work out the carrying amount at the end of the year, which is your cost price at the end of the year, minus your accumulated depreciation. Note number 4, inventory. That would be your trading inventory plus consumables on hand. Note number 5, trade and other debtors. It would comprise of your trade debtors minus your provision for bad debts to get your net trade debtors value. We add any prepaid expenses, accrued incomes, or deposit for water and electricity, or if our SARS income tax has a debit balance. Note number 6, cash and cash equivalents. This comprises of a fixed deposit which expires within 12 months, savings account, bank, cash float, or petty cash. 7. Ordinary share capital, authorized that your ordinary shares without par value, issued shares, shares in issue at the start of the year, shares issued during the year at a value per share, shares bought back at an average issue price, and that gives you your total shares in issue at the end of the year. Note number 8, retained earnings. Your retained earnings at the beginning of the year, net profit after tax for the year, and minus your retained earnings on shares bought back. Your dividends, interim dividend paid, final dividend declared, and that gives you your total retained earnings at the end of the year. Note number 9, trade and other creditors. You'll take your trade creditors, add your accrued expenses, income received in advance, creditors for salaries, pension fund creditor, medical aid creditor, and shareholders for dividends, as well as SARS, which comprises of your income tax if too little tax was paid, and pay as you earn. Note, the shareholders for dividends can also be presented on the statement of financial position or balance sheet under current liabilities.